Hello, and welcome to today's KraneShares webinar, Tariff Briefing and Q&A with KraneShares. My name is Brendan Ahern. I'm the Chief Investment Officer of KraneShares Exchange Traded Funds. I'm joined today with my London-based colleague, Dr. Xiaolin Chen, our Head of International. Global markets have experienced a significant downturn driven by the sharp escalation of tariffs by the United States government. We find it most unfortunate that US and global investors have suffered 10 trillion of losses due to the lack of knowledge or the ignorance or ignoring of economic laws taught in Econ 101. We have long argued that the vast majority of China news are dominated by hyperbole, exaggeration, and factual inaccuracies. It is our belief that the events and market action taking place are forcing a reality on the media, on politicians, on government officials, and investors. The fact that the US and Chinese economies are highly intertwined. Everything we're going to speak today you should check yourselves, not from our data, but using services like ChatGPT, DeepSeek, or Perplexity. The data and truth are available. You should be skeptical of what we say, just as you should be skeptical of some of the mistruths that continue to be spoken about China's reliance on the US. The lack of data to support that argument is why you're seeing the Chinese government in this art of the deal play several cards based on the simple truth that China's economy is not dependent upon the United States. 1.4 billion people in China are not making iPhones that are sold in the United States. And yet that is a perception that we find continues to be perpetuated. So the objective is to give you a view of the composition of China's economy, what's actually very important to the Chinese government today. Okay, so first and foremost, please actively ask questions during the webinar. You can use the Q&A button. We'll take those questions on during, and we certainly, in advance of this webinar, we've got a number of great questions. If you're viewing us on KraneShares.com, please email us at info@KraneShares.com, as well as if you'd like to receive today's presentation, please email again at info@KraneShares.com. If you're joining us on Zoom, please use the Q&A button for CFP, CIMA, and CPD continuing education credits. Please email us at ce@KraneShares.com. Okay, so just briefly, for those of you maybe a little bit less familiar with KraneShares, our founder, Jonathan Crane, formed two core beliefs during his experience living and working and building a successful business in China. Those two beliefs were the basis for founding KraneShares back in 2012. The first is that new China economic sectors such as domestic consumption, internet, e-commerce, semiconductors, clean energy, and healthcare have become the new drivers of China's economic growth, and yet those sectors remain underallocated in global portfolios. The second is that the opening up of China's mainland equity markets, the second largest in the world, would have a significant impact on investors' portfolios. Most importantly is the combination of these two factors, and why John created KraneShares is that we endeavor to earn the trust of investors through our balanced, data-driven perspective on China's economy and capital markets. The rise of China's economy, as well as its percentage in global indices, necessitates global investors have a partner to navigate these developments. Xiaolin, myself, as well as our colleagues at KraneShares, endeavor to earn that partnership role with you today. It's why we started our China Last Night research blog many, many years ago in order to provide a daily data-driven perspective on what's happening in China and in order to keep you abreast of new developments as they occur. Once again, if you have questions, please proactively email us at info@kraneshares.com or use the Q&A button on Zoom. Okay, let's dive right in. As you're aware, um, there's our primary business is exchange traded funds. Um, we're known for our China suite, but I'd offer that same data-driven, research-driven perspective supporting our exchange-traded funds is shared by my colleague Luke Oliver and his efforts to inform investors about carbon credit allowance futures. We've taken a lot of things we've seen in China and applied it to global and emerging market equities, as well as we've launched a number of exchange traded funds on behalf of partner firms such as Nancy Davis at Quadratic and Ivol, our friends at Mount Lucas, and taking their long run and managed futures strategy and listing that with KMLM. Man Group, the largest global equity hedge fund manager globally, taking one of their strategies on how private equity investors apply and buy companies and applying that to public equities, as well as the great research firm Hedgeye applying their risk informed investing research to US equity markets with a K-SPY, a product that just self-serving here has really done very well versus buffered and principally protected US equity ETFs. It's definitely worth checking out. But let's dive into why we're here, which is obviously, we've seen a very sharp escalation in the U.S. tariffs on not just China, but also the really every country globally, including countries islands that don't actually have any people on them. That we've seen a very, very hard negotiating start to the art of the deal from the U.S. side, but it's just impossible to ignore how tough the tariffs were put onto China, and I think that explains on the next slide, really why we've seen China come back, really with a strong response, to the U.S. tariffs. That the first trade war showed us that China is a country with a lot of pride. I think we saw that in with Canada, when Canada was targeted with tariffs, it actually created this groundswell of elbows up. National pride in Canada, but we're also seeing that in China, and that's part of why, just as we saw in the first trade war, we've seen China actually using the exact same language from the first time around, which is that they're simply not going to take these tariffs. They will retaliate. I think it is worth highlighting that China is not retaliated at the same level as the U.S., which potentially shows that the door for negotiations can occur, and we certainly hope so. But I think another reason why you're seeing this retaliation in response to the U.S. tariffs, and then unfortunately tit for tat on the next slide, is that I think going into this trade war, there was preparation from the China side. I think there was, I just assume, a deep study of the U.S.-China economic trade, and China is not as reliant in terms of export-driven manufacturing, in terms of their aggregate sales to the United States, as our perception. I really do believe, and particularly here in the United States, that there's a perception, Xiaolin, that everyone, all 1.4 billion people in China, are buying, are sitting in some factory making iPhones that are going to be only sold here in the United States. I really do believe that that is the view, and again, I think that's part of, maybe being based here in the United States. That's, I think, the view perpetuated by the media. But China is far less reliant in terms of trade with the United States. And yes, some element of that trade's being redirected, but I think this decline is very real. And on the next slide is, I think this is the real key point. And again, please doubt us. Please go and check this on your own. Use ChatGPT or DeepSeek or Perplexity, which is part of the reason for this retaliation is the reality that if you look at the trade data, and if you can look at it from a China side, you can look at it from a US perspective, the data tells you the same thing, which is that China is not as reliant on export-driven manufacturing as they have in the past. That actually the peak percentage of exporting as a percentage of GDP was back in 2006 at 36%. That's down to 19%. Now the 19% of China's GDP is goods and services. So what we did was we said, okay, if we strip out services, what about and this is an economic term, export-oriented manufacturing. So we're stripping out things like, agriculture that, if you grow corn, there's not a lot of value add, or you mine coal, there's not a lot of value add. So we're stripping out raw materials, minerals. We're really looking at, things made in factories. And that is 11.4, call it 11.5% of China's GDP. You then apply, well, what's the number of that going to the United States? And this is, I just think, is so critical here. It's less than 3% of China's GDP is reliant on exports to the United States. And I think this potential escalation in tariffs is a bit of a miscalculation. That here on the bottom is just we simply look at what's the composition of China's economy. And this third industry, which is the third to the developed, that if you went back 40 years ago, the only industry in China was agriculture. And that's why they call it the first industry. Then you look at manufacturing, construction, infrastructure, and then you have the growth of the service economy. So I think this does explain why we're seeing China escalating. And on the next slide, I think there's another issue that is so key, Xiaolin, which is this rise in other parts of China's economy. And I think we show that on the next slide, where the U.S. is actually the largest exporter of services to the world. And so, that everything that in this dialogue, actually, if you can go back one slide 8, and thank you. That everything we've been spoken about in terms of trade is goods. And remember, a good is something that is manufactured and put on a plane or put on a boat, but ignores services. So this trade war hasn't even got into where the US economy is arguably ill prepared, which is services. The other thing that we've been talking about for years is that the definition of a U.S. export is something manufactured here in the United States, put on a boat, put on a plane, and then sold in China. The problem with that is that many U.S. companies, Nike, Apple, and others, they manufacture in China and then they sell that good in China. And years ago, the New York Federal Reserve, it's under Liberty Street Economics, their research blog showed that if you included, this is 2017 data at the time, that there's $500 billion of sales, exports plus the multinational sales. So if you add the hundreds of billions of goods manufactured and sold in China by US companies, you add that to US exports, there is no trade deficit. And that is one of the root issues in that the Chinese government uses that number, uses that aggregate versus the US is just looking at sole exports. But I think Xiaolin, on the next slide, the world's changed. The world's changed, and I think that's again probably explains a little bit of the China response.
I'd agree, Brendan. I think, like you said, China somehow is preparing for these scenarios, maybe not to the exact extent that we have experienced. On the next page, what we have really just a summary. I think many of you listen to me and Brendan on a frequent basis and check out on China last night, the blog Brendan, right? You would have followed all these updates on the policies introduced by China. Many people refer this scenario in September. If I could take all of you a step back, remember from September 2024 last year when the policy bazooka get announced in China. Many say, oh, finally they have wake up to it. I disagree. I think China has been doing easing policies from Q1 2023. From then, they started to cut interest rates, cut the lending rates, cut the mortgage rates, providing slightly cheaper credit and cheaper, stabilizing the housing market, so on and so forth. Yes, it's until September we have heard this unprecedented tone of delivering a strong policy from policymaker in China, and really decisive measure get introduced into the market. In my opinion, it's really them knowing a couple of things. One is they potentially face uncertainties to externally versus what they can control domestically, and realizing for this economy to continue to grow sustainably and for long term, it would have to focus the domestic market strongly and even more in that instance. That's why you see these billions of renminbis introduced in stabilizing fund, for instance, and also the long-term ultra long-dated bonds get issued, and all these policy gets introduced into the market to help the local government, helping the bond, long-term bond issuance, special purpose bond issuance, so on and so forth. All these policies, I'm not going to bore with you with every single one of it, but to me, this is very clear of the government realizing the potential challenge as one. Second, they are now preparing at that time was a lot of monetary, physical regulation policy, so on and so forth in place to help the markets to grow domestically. It's very clear that was the message. But a lot of people saying, well, hold on, they still have this issue of real estate market that is facing the challenge in China. I want to remind you some of the issues in investors' minds saying, is China ready to help in this extreme scenario with this tariff? Let's just say one policy, mandatory, macro, physical, all these stays very accommodative as if from the September last year. If you turn to the next page, I want to touch base on the real estate markets. I've made myself a little bit too clear that I somehow was bearish on real estate market because my experience of my own family. They buy the house very cheap price and it's sold by multiple times. In my opinion, is unbelievably good for them. But I think the market is long due for correction, which it has happened from earlier, 2020, 2021 during pandemic time, particularly the activity halted, and then over these 3-4 years of consolidation, I do think a couple of things has happened. One, somehow you can say the bad apple gets squeezed out as one. Second, the inventory is at extremely low level. The price has consolidated. And also, in many ways of the supporting policy, supporting measure has also been put in place. We call them the put policy being activated in this market. That's why you see many indices. You don't, you look at ours and you look at others indices, you can start to see the sign of a recovery in this housing market is very clear from late last year that it started to rebound it from this level. I do think it's here to stay for this trend to be continue from here. You may see a bit bumpy, but the trend is firmly here to stay. Many Chinese household may get a bit of a mark-to-market, correction, but the actual impact to many Chinese households is very manageable to minimum. The reason I say that is not to discount the price correction. It's really the Chinese household has very, very low leverage. On average, probably about 30% of the household is borrowed a mortgage on average. Okay, that may be slightly higher, lower, but on average, it was lower relatively compared to our developed market. I live in London. You can literally put down 5% deposit and own a house. In China, people tend to put down 50% of deposit and own a house, or even 100% in cash, which is the case for my dad, owning 3 houses, both bought by cash or bought by cash. So in this instance, mark to market, yes, they experienced some losses, but at the end of the day, the impact to their wealth was quite managed in that instance. So if real estate market is stabilizing, we literally start to see buying activities in the secondary market in China, and then 70 cities, housing prices indexes tracked by Goldman, and also us here showing the 100 city housing price indexes start to show stabilizing signs. So it will be a bumpy road ahead. It won't be a straight line up, but then the trend is very clear. It's stabilizing from here. And if you ask me, say, right, they have dealt with the biggest issue per se of the housing market that impact household sentiments towards their wealth is start to show sign of stabilizing. The Chinese government has been introducing policies to support their own economy in China. Can they do it this round with the tariff increasing? The next page, what we want to really highlight is this year has marked quite a lot of significant events. Beginning of the year, the government policymakers are meeting in Beijing. And in February, President Xi Jinping met a lot of CEOs, which I will touch base on slightly later on the pages. And then March, they had the NPC, they said economic targets, so on and so forth. But in all these all together, all these statements that announced here and there in different meetings, so on and so forth, one thing come up the most and all the time on top of the agenda is consumption. The reason for that is very, very clear. Consumption used to be in China contribute about 40% of China's GDP, 40, and at some point it was over 40%. And obviously pandemic happened, so on and so forth, that consumption came down. But at latest number was still at 39, high 30s. The goal is really for consumption to grow as developed market to 60 or even higher. So how can they do that? Of course, they can do that. Not to being arrogant. They have a market with billions of consumer in one country, very complete supply chain in the country. They can really self-sustain themselves for a very long period of time. And it's a society very modernized and innovated. I encourage many of you to just look out how innovated, how modernized the society is in some of our articles or even some of the videos that recorded by our local, our analysts based in China. In this instance, the tariff obviously accelerates a lot of the agenda in China. And one for most important is the stimulus package on consumption. In March, when they had the NPC meeting, consumption is already on top of the agenda. Brendan and myself, we constantly talk to our counterparts in China, the asset managers onshore in China, in Beijing, so on and so forth, almost on a daily basis. It's led us to believe there's a pile of policy that is ready to pull the trigger. Obviously, they got to decide when and how they're going to decide of pulling these triggers. But in our opinion, this acceleration, it's easy to say, then you feel the pain of the market correction. But let me tell you, the 84%, 104, it doesn't matter. The number become irrelevant. It's really how China will say, okay, if my 2.3% of my GDP as an export going to get impacted, can I find elsewhere of that 2.3% nominal GDP of growth domestically in the economy? The short answer is pretty much straightforward. Yes. Why? Because they really have the monetary toolkit to support this economy. They haven't even used much at all, not even talking about exhausted. So this is our belief, and also led in all these announcements in Chinese media on how they're going to focus on more of a domestic economic growing. If you go to the next page, I want to highlight a few things of the recent engagement by the Chinese policymaker. You can get a sense, are they really doing what they say they will be doing? So this is obviously all the announcements I mentioned, so on and so forth. But one key event happened was really in February. This is right before the two sessions, NPC, that Xi Jinping met with all these, they call them private entrepreneurs, but private doesn't mean it's not a public company. It's just not owned by state. It's used to differentiate it. It's state-owned or privately owned by shareholders and people. So this is public companies, CEOs, all the people were there shaking hands with him. This is a very rare case of scenario of the country's leader meeting private entrepreneurs, CEOs. To me, as a Chinese, when I read all these news, when I see all the actions, all the statements after that, this is very clear to me. It is a very, maybe an elegant way or whatever you call them, of the presidents asking these private CEOs, please go and expand your business, please grow your business. We will promise to keep the regulation accommodative. We will keep the credit cheap. We will level the playground to remove the hurdles for you to access credit, so on and so forth, and different sectors that restricted for you to allow you to be confidently to grow your business. This is a very clear message. Why is that? Because all these CEOs jointly, these private entrepreneurs jointly own or contribute or accountable for 80% of China's job market. 80% of job market. So it's very clear they create jobs. They want these corporates to continue to build and continue to expand, so on and so forth. You say, fine, they ask him to do it. Will they do it? The answer is yes. Why? How can you know? Credit is a leading indicator. I always watch them very closely. Okay. Obviously 1 month, 2 months data, but it's a few months already, 2 or 3 months already. You can see corporate credit, household credits are picking up nicely, inch by inch. You don't want them to shoot up. You want them to pick up, months over months, steadily and for a very long period of time. So clearly the credits, the corporates are borrowing the credits. Why would you borrow credits unless you really want to expand your business and continue to grow your business, so on and so forth. And I also mentioned that the government themselves have not even used or exhausted their monetary tools. One tool they used was the special long-term dated bond that they issue to the nation and people can buy. People literally line outside the bank to buy those bonds. They issued them once last year, really to just see how the market will react. They oversubscribed multiple times. They haven't done it for probably a decade and a half. They really have a lot of ways to do it. They have the highest FX reserve. Obviously, so there's a lot of monetary tool they can still use to help these companies, particularly these platform companies. Brandon will touch base on their revenue, so on and so forth later on, but these companies are very domestic focus. Their revenue is mainly generated domestically in China. If these corporates are continue to grow, because they face domestically anyhow, if they continue to face, to access the credit, take advantage of the policy, and government continue to support them to grow in the way that they promised them to do from last year, these companies continue going to be doing well. And then you say, right, can China issue more debt? And they have a lot of debt. If we go to the next page, we just put some charts here to show you, can China still borrow a little bit more, and can they continue to issue some debt if they chose to? It's a very simple debt to show here, similar charts to show here. The government debt to GDP clearly shows they have a huge room to achieve what they desire to achieve. Remember, they have gone through a very, very long period of deleveraging in 2015. They are now better educated to know how they should handle this leveraging or borrowing process in the country to support the economy. Needless to say, they have other tools to do it if they chose to. So there's just a couple of charts, and obviously structurally, China is positioned or encouraged to continue to grow the economy in any ways they can to really let the country to continue to rebalance to consumption service driven. The next page I showed here was really some structural issues we always discuss and face, like hukou systems. For those of you who doesn't know, hukou systems is a registration systems where you were born. Like I was born in Harbin. Harbin is a northeast city in China. Think of the map like a roster with red at the head there, very northeast in China. If I was born there, my little ID would show Xiaolin was born in Harbin. If I work in Beijing for many, many, many years, I'm not eligible to buy a house in Beijing. That's how restricted the hukou system is. And my children, so on and so forth, all follow with my hukou system, would go back to Harbin and study there and do their exams there, not allowed to do, in the city where I live or work. So that's how restrictive that is. That has become very relaxed. You say, well, if that's relaxed, what was that to do for the consumption consumer? One classic example, if I live in Beijing, work there for years and contribute the growth and growing there and so on and so forth, I'm not eligible to buy a house there. Now I am allowed to buy a house there. Okay. When I work in the tier 1 city, tier 2 city, I'm allowed to attend education there. I'm allowed to contribute, to the national healthcare systems. I'm also allowed to consume more in that city. Those removed will allow people to increase, their spendings in different cities, more freely move around the cities, and you would see activities pick up as a result for that as well. Demographic declines, I think, obviously. This is really to say that China's would have to continue to rebalance its economy to become more innovative, more automated to deal with, per se, the aging population. I slightly disagree with the aging population because China has a slightly different system to say when and where you can retire. In China, as a woman, you can probably retire at age of 50. You must be kidding me. Okay, in UK it's 68. 50, life only just started. Now they obviously increase the age, level to say you can retire. This was last year's action. You can retire slightly later, but still 50 plus, 52, and then some 55 get moved to 58. 2 or 3 years moved up. I think easily they can deal with these challenges to allow these people. Anyway, when they retire at age of 50, they try to find another way to get back to the industry. Because what are you going to do at age of 50, sitting at home, retired? A lot of people still looking for jobs to come back to the job market. If this is official, you would allow more skillful, more knowledge, workforce to return in the work market. This obviously will delay, if you say delay, or fix certain problem of the early retirements and calling them a bit of an aged society. And obviously you constantly have incomes, you will continue to encourage yourself to spend. All these issues, in my opinion, is this tariff, yes, it's going to be a short-term issue for China and the US. And if you look at China's side, what do they buy from US? Aeroplanes, energies, electricals, and agricultural products. Can they find alternative near-term needs of the agricultural products elsewhere? I think they have been preparing that with some of the countries. If you see their exports to developed market has been declining over the last 20 years by nearly 20%. And they're trading with the One Belt, One Road partners, the trading with ASEANs, the trading with frontiers has gone up proportionally by 20 and 15, certain percentage gone up. So now developed market and their One Belt, One Road partners and ASEAN partners are par to par around 30, 40%. And obviously, China would have enough liquidity to focus its domestic economy. And then I hope both sides become more mature and sit down and talk, get things resolved. That's the most ideal world. But China is never a liquidity issue. If you go to the next page, I want to conclude my side, leaving you with this page. This is the total bank deposit in Chinese household. You can see year over year, their savings has gone up. Okay, this is a percentage of steadily going up. China's issue, probably some people say it's probably the sentiments towards this asset class. But since September last year, this sentiment has, definitely firmly changed the direction of, contributed or attributed by the Chinese policymaker decisively supporting the right path of the economy or focusing domestic economy, period. And then domestically, can people continue to spend? Can people continue to boost this consumption? In my opinion, if you look at just this savings of nearly 20-30% of the the total bank deposit is as of GDP number. China is not short of liquidity. If they continue to do the decisive measure, boosting domestic economy, that stocks and companies that having high exposures to consumption, stocks and companies has high exposures to domestic consumer will definitely benefit from this trend, benefit from escalated stimulus on the consumption side. Brandon.
This unleashing of bank deposits is a key. Now that the Chinese government knows, Trump kind of came full on with taking the hardest position from a negotiation. They're going to want to unleash that capital in banks to get that into the domestic consumption economy. I think we wanted to take a moment about some of the things that have progressed over really the last, not just year to date, but really over almost call it the last year and a half, which is the rebound, the re-rating of Chinese equities. And I think for the vast majority of investors, this re-rating occurred with mid-January, the DeepSeek announcement, which really undercut one of the main pillars of American equity outperformance, that you needed these very, very high-end chips, and you were going to need a lot of data and a lot of cloud and a lot of energy. And DeepSeek, which I don't think would have been feasible without OpenAI's investment, really showed that you could progress. The next evolution could be done very inexpensive, very, very low energy necessary, as well as, most importantly, not necessarily needing those super high-end chips potentially. So I think this forced the issue of the re-rating, that you had U.S. chip companies trading at 40 times sales when you had Chinese e-commerce companies trading at 14 times next year's earnings. Again, we do think that the Chinese equities bottomed in January of 2024, and have grinded higher, yes, with volatility, but we do think the bottom in Chinese equities was January of 2024, not 25. Now on the next slide, I think the geopolitical issue continues for U.S. institutional investors to be a headwind. But what we're seeing is this re-rating of Chinese equities is certainly taking place outside of the U.S. That we think, as that your slide showed, Xiaolin, about the global, many countries are far less reliant on the U.S. economy versus the Chinese economy. And a lot of those countries, if it's commodity orientation, it's geography, is it high level of economic cooperation or multinationals doing business in China. A lot of institutional investors from those type of countries are going to move potentially sooner than U.S. institutions because of geopolitical. On the next slide, it's important that I think you really do, when you're thinking about the Chinese investment opportunity, you have to look at the composition of some of these benchmarks. And for ourselves, our focus, based on our founders' experiences, you want to focus on the growth opportunities, and that means going in and taking them out. And I think this is very critical because the broad definitions of China include heavyweights to financials. And how does a bank make money when the difference between a 1-year and a 10-year treasury is like 20 basis points? How does an energy company make money, not just in China, but globally, if oil prices are plummeting? I think it's going to be really hard, right? And that's where we think you do need to segment out, I kind of jokingly call it the good stuff, right? These growth companies. And that's what's interesting is a lot of, a lot of equity strategists are stuck using MSCI China as their China proxy. But you as an investor don't have to. You can go in and pull out the good stuff, right? These growth companies. And I think that's why within the China equity universe, the one analyst that is banging the table about the opportunity are the internet analysts. If you look at the analysts from Goldman Sachs or Morgan Stanley or UBS or CLSA, again, the where you're seeing a re-rating, where you're seeing a fundamental improvement are the internet stocks. Now, the next slide. That one investor we continue to buy stock hand over fist are the companies themselves. We're seeing um, companies like Alibaba only increase their buyback on down days. They actually buy more ADRs on down days. Tencent, just a prolific buyback. But we're also seeing companies that had never done a buyback, never done a dividend, become very shareholder friendly. And we think this element of the internet companies has been really under publicized. But certainly that we saw that in the Q4 earnings where many of these companies beat on earnings per share growth because that number of shares outstanding is actually declining. And again, based on our forward-looking views on domestic consumption stimulus, we're really hopeful that we see, the rebound that started to take place in top line growth, only accelerate further. On the next slide, the other investor that continues to buy hand over fist is in mainland investors buying these growth stocks via the Southbound Stock Connect program. This is the trading platform that allows investors in China to buy Hong Kong stocks. And that number, just yesterday was the largest net buying day ever from mainland investors in Hong Kong. This slide is only a day old, but it's a world's under out of date because you've seen this buyback go to I think it's about $70 billion now year to date. I'll note that today was a slight outflow, but that was really in two ETFs, Xiaomi as well as Alibaba. Very, very strong buys today. Yesterday, Alibaba and Tencent exceedingly strong buy days. So investors in China see the opportunity in these growth stocks. On the next slide, we are seeing institutions, the China's sovereign wealth fund, insurance companies buying Chinese stocks predominantly via exchange traded funds. These are the 10 largest ETFs in terms of year to date inflows. Just on April 7th and 8th, we had about 109 billion of net inflow into Chinese equity ETFs in China. Very, very strong inflow. So this is these long-term investors, Social Security fund, insurance companies, the sovereign wealth fund, actually buying Chinese stocks via these exchange traded funds. On the next slide, I think it's so critical that investors are aware that the companies we hold within KWeb, they have basically no exposure to U.S. The only company with any real U.S. exposure of significance would be Pinduoduo, who we estimate it's about 15% of their revenues generated here in the United States. But for the other companies, it's de minimis or non-existent. That actually is more exciting because if we see this domestic consumption policy bazooka come, which could come, there's a lot of rumors, it could be as soon as tomorrow. We know that the companies we hold in KWEB are the beneficiaries. Moving on to the is that um, because of concerns we had about a U.S. delisting risk with the holding foreign companies accountable, that holding foreign companies accountable, the Chinese government changed the Chinese law, which allows the PCOB, the Public Company Accounting Oversight Board, to view the audit books of the auditors of US listed Chinese companies. That if you go to sec.gov/HFCAA, you will see that all US China ADRs are compliant because of this audit review process. There's another about 16% of KWEB we could convert to Hong Kong, but those Hong Kong share classes don't have the share volume. We recognize that, could the ADRs be, could that become part of this unfortunate trade war? We certainly don't believe so. We think the Chinese government changing the Chinese law to allow the PCOB shows that they do value the cooperation financially between U.S. exchanges, U.S. investors, and Chinese companies. I think that is an area that is very important, very similar to ByteDance, that with TikTok, that this is a Chinese company, but just as the US ADRs are predominantly held by US investors, it's very similar to ByteDance, 60% owned by predominantly US private equity. This is an area that we don't believe should be brought into any sort of trade escalation. On the next slide, I really do believe investor positioning to the space remains very, very light, if not insignificant, particularly here in the US. Despite this underperformance of US equities, and I think a re-rating out of US equities is taking place, that we've really not seen a reaction from US investors that despite significant outperformance of the Chinese market, on a relative basis to European as well as US equities, we've not seen investors allocate. And I'm disappointed. And we think certainly we're on the precipice of this domestic consumption policy bazooka, and yet investors are significantly underweight. On the next slide, we've utilized and we continue to the Copley Fund research. Their data on actively managed mutual funds shows that remarkably 25% of actively managed global equity funds have zero China exposure. And again, that's against the backdrop of relative and absolute outperformance. On the EM side, obviously it's EM managers have to hold China. But on the next slide, we show that there is this significant underweight to China. And again, we're starting to see a real percolation in those markets. And yet, the closing of these underweights represents significant capital allocation back into the space. On the next slide is what we hope will occur, which is cooler heads will prevail. I think it's really worth noting, Xiaolin, that both the Ministry of Commerce as well as the Ministry of Foreign Affairs held press conferences with reporters, and as well as much as they talked tough, they said that they're not going to back down. They definitely left open the door for negotiation. That was very, very clear. And we think there's opportunities for an off ramp. Yesterday, a U.S. Small business that's reliant on China imports filed a lawsuit in Florida court challenging the usage of these executive power to implement tariffs. And again, some of this might just be it'd be an easy way for potentially the U.S. to de-escalate. But certainly, you're seeing increased U.S. publicity on, what tariffs are going to mean to, already talking about the holiday shopping, the increase in prices of toys and Christmas tree lights, and I think it's very realistic that the chips needed for U.S. defense are made here in the United States. Certainly auto, which is relying on Michigan, is a swing state. Steel and aluminum. Pennsylvania is a swing state. We understand card, but the vast degree of what China does import into the United States is low end inputs into high grade U.S. manufacturing and bringing those those factories back, and the pollution, environmental consequence makes absolutely no sense. So hopefully cooler heads prevail. But I think we've certainly attempted to articulate the economic realities of the trade situation between the US and China. The US economy, 70 to 80% is focused on consumption, and certainly less than 3% of China trade reliant on the US. And certainly this domestic consumption stimulus, which we do believe is coming, we believe can more than offset that loss to GDP. We'll go through some slides, but yeah, obviously, Xiaolin, I just think our perspective, we did the work and we looked at the data, and it's not what people think, just not. I mean, it's almost shocking, some of these misperceptions. But I know, we've left some time for Q&A. I know we've got quite a few questions. Any that jump out to you, Xiaolin?
Yes, I think I saw one. We got to answer. We got to answer Rich Green. I think Rich, you sent a lot of questions. We'll try to be fair, answer some of it, and then we let some others have the question. Obviously, I think this is a great point. Brennan and I just, walk you through based on the factual. These are the data. This is what it's saying. This is why they're doing this. This is why they're not panicking, because of the proportionally is less significant. But I think it's a very fair question from Rich. Was saying, what is the other side of our argument? What are the things that could potentially be a strong debate on the other side? What could be against our position? In other words, what keeps you up at night? I think Brendan and I have different lists. China last night block keep you up. Yeah. Do you want to share a bit of we'll get that answered, and then all the other questions are more around things we discussed.
Yeah. I mean, I think we do believe this is an element of the art of the deal. We think this very, very hard stance from the U.S. side and in this engagement has brought back this geopolitical concern. And I think regardless, what I think about a lot is that there's a lot of investors really, I think it's so important, that there's investors that just don't care about the geopolitical because they know the companies in KWEB have nothing to do with the U.S. economy. And, today in Hong Kong, 43% of Hong Kong trading was from investors in China, and they were in there buying, Alibaba and Xiaomi and Tencent and others. And I just do believe that, we get all this volatility during U.S. trading hours, but there's a reason why we hold the Hong Kong share classes, because we believe we're going to be beneficiaries, and then the companies themselves. So yeah, I think we remain very bullish. I think we're bullish because of that segment. We're bullish because of the improvement in the fundamentals were bullish because of the coming China domestic consumption stimulus, which is actually what the administration wants, right?
Mm,
Um, and and I think the geopolitical is, it's the big overhang on the space. And I just think that in a day of age where you don't have to rely on the media to understand the truth, the data, I just think it's going to have a real effect where other people will say, hey, how much is China really dependent upon the US? And they'll come to the same conclusion, which we came to, which is not a lot, and so I think that transparency on the truth is rising every day, and there's so much hyperbole and exaggeration that perpetuates what we read in the media. I just think that that's starting to go away, and I think the markets have really taught. It's really unfortunate what happened, totally self-inflicted, but you cannot defy economic law. So I'm going on, so anyway, yeah, I'm really bullish. I added to my K-Web position last Friday, which was a little early, obviously, but yeah, I think cooler heads prevail because you can't ignore this the data. And that was very similar. I know Chris had a very similar question about, why are some of these companies like a PDD or JD down so much? And I just think it's, PDD is the one company that does have some US revenue exposure. Um, PDD doesn't disclose what that revenue exposure is, but you can kind of extrapolate it, which is why we come to the 15%.
mm,
Um, and and I think for JD, I mean, we just see it as such a beneficiary, particularly the more recent policies on home electronics, which is really JD's sweet spot. Obviously they're going to be a beneficiary of consumption, but yeah, just to Chris's question, yes, how is this not the bargain of a lifetime? Um, and we don't disagree. It's just the geopolitical is it's just
mm.
such a headwind for the U.S. line, which is again why we prefer the Hong Kong line when we can, where there's ample liquidity. I think one question, Xiaolin, that's come up is, will China devalue their currency in response? I mean, my thought was, when you devalue your currency, you make everyone in your country, your citizens, poor, right?
Mm,
Which
yeah.
goes against raising domestic consumption. And then, with the tariffs at 105%, or
Mm,
you're going to devalue the currency by 100%.
yeah. It's
I,
not going.
I, I, I find that hard to believe. What?
Yeah, it's not a, I think that's not a desire. And also China, has long gone the period of needing very cheap currency for the very low value chain exports. Today, their exports is technology, it's machinery, it's high value chain stuff. So, and they also buy stuff. So I think in 2000, early in 2000, it is slightly desirable or favorable policy to slightly value or devalue the currency slightly to the lower, which can help a bit, but now it's not the preferable. It's probably more driven by the volatility as one. Second is the interest rate policy on the two nations are slightly different now. I think China is firmly on the cut, and they have the room to cut more. So and U.S. potentially, I don't know where we're going to be. Fed going to head to hold it where his sounds like most likely. So if that is the case, then obviously it's more of the interest rate differential play a key play here.
Yeah, for sure, for sure. And I think that's yeah, that's kind of always been my view that, the weakness we've seen in the RMB was really driven by the US 10-year Treasury, hitting a 5% Tuesday night. Um, just give such credence to James Carville saying, if I want to come back in my next lifetime, I'll come back as the bond market, because the bond market really is what forced this mea culpa. Um, and so, yeah, as U.S. Treasuries go up in yield, it's going to strengthen the dollar, which obviously is the opposite of what the administration wants. They want a weak dollar to help U.S. exports. They want low yields to allow refinancing of houses, auto loans. Um, one interesting question from Kate was around the Thulicides trap, which is this idea, and I think I always recommend Graham and Allison, two Harvard professors who wrote a great book on Lee Kuan Yew. If you want to understand China, Lee Kuan Yew, this great book by Graham and Allison talk about he was the kind of consigliere to Chinese leaders, but Allison has promoted this idea of Thulicides trap, that the rising power has to go to military conflict with the incumbent power, and I disagree. I think it's 2025. You know, you have a problem with somebody, get on an airplane, go see them. Go have lunch with them or dinner. Comparisons of Sparta and Athens or
Mm,
Rome and Carthage. I mean, that's what, I just find it laughable. There's such a high level of dialogue and communication feasible between the US and Chinese diplomatically, and business people, including ourselves. We get on airplanes and we go meet our counterparts. We go meet companies in China, and
mm.
seeing and experience what's happening there, really, I think would go such a long way to resolving this. And yeah, hopefully that does occur. I just think the hyperbole and exaggeration in Washington, D.C. when it comes to China, potentially, driven by a more, defense, not non-economic. Yeah, it just would be incomprehensible to me that you can't go and meet and talk it out. Go play a round of golf. Yeah. Any thoughts there, Xiaolin, yourself?
Um, we got a lot of questions. I can. Do you want to touch a bit on Star? Well, there's quite a lot of questions on KWEB. We address KWEB all the time. Do we touch base a little bit on K-Tech and K-Star? One question from Jim.
Well, I think, yeah, I mean, obviously, I think foreign investors, are really going to gravitate to the kind of the K-Web companies, K-Web. I do think it's important, Jalen, that you're seeing this pivot from within China towards supporting their stock market, which is very rare. It really truly is. And I always go back to that. Culturally, China uses subtle signs to communicate. They don't necessarily tell you, but literally they're telling you that the Chinese government, these long run investors are buying exchange traded funds listed in China hand over fist. I mean, the numbers are really astronomical. We give you the tickers that these are the tickers these entities are buying, so you can track it yourself. Look at what the flows, look at those tickers. Don't trust us. And so yeah, I think the this is not just an offshore market. It's not just a K-Web story. That the
Mm,
mainland market, if for us it's KBA and K-Star and Chin in Europe, the re-rating of mainland by mainland investors is taking place, and I think I think that will only increase. Just the government said this is what we're going to do, and if they can keep pushing the policies to support real estate, which is happening, and more domestic consumption, that will re-release these animal spirits in the mainland market. So it's an onshore as well as offshore narrative, and as much, for me, I own I do own a lot of KWEB, but personally, I also own a lot of KBA or MSCI China A. Chin is kind of the equivalent in
Mm.
London. So yeah, I think there's an opportunity on both sides, onshore as well as offshore, for sure.
I think the national team, obviously for those less familiar, is a group of team like people, institutions in China that are set as a team to support the capital markets in China onshore period. When they see valuations become attractive, when the sell-off happened like a few days ago, they come in and buy the market.
Hmm.
Some are like a pensions, manage the big pensions and they manage investments from the country, national level, so on and so forth. It's just like in Japan, was it 2015? I can't remember the exact year when the pensions start to buy the ETF market. A lot of ETF issuers or the asset manager onshore in Japan just experience billions and trillions inflows. It's exactly what like that happened in China. The national team is a long-term buyer. They are there. They have announced the stabilizing funds which they will use to buy this market. And then a few days ago, PBOC, Bank of China, Central Bank of China, announced that if like a Huijin, all these companies are part of the national team, need liquidities to support their purchase, they will borrow them. Period. So you have the central bank backing them up to say if you need to buy, you need cash, you need liquidity, we are behind you. This is where we say, the policy bazooka announced by them was unprecedented. The tone, the support, the level of support they have. And I think, Rich, you asked some questions like the source and so on. It's very clear. Last year, like I visited China 4 times, but all of the time, like I went with you, I went with John. March, when John, our CEO, we want to see CSRC, the new boss get taken the office. And it's very clear. We sat with on the table with 5 of the other senior people, including the chairman, offside of ours, asking us how can we help the investor. These people are very much understanding the international investors' preferences, how they deal with things, keep things transparent, communicative, which they did all of that since March of this year. That's why all the regulation introduced by the Chinese policymaker didn't cause any market correction whatsoever. And they continue to support the market, make it healthy, so on and so forth. So you have that as a source. And it reminded me also when you mentioned policy, was June last year when John attended summer Davos in Dalian. Dalian is a northeast city in China. They hosted summer Davos in Dalian. And then John wanted to attend it. I was fortunate to be there with him, but not in this meeting, which he got invited to have a closed door discussion with Premier Li. Premier Li invited 15 global CEOs to have a closed door discussion with him. And John was one of the CEO was at there. They had a closed door discussion over an hour and a half. So all the discussion was centered around his belief of supporting China in 3 sectors. Okay, consumption, innovation, technology. So all of that is actually in our KWEB fund. He mentioned he wants those industry to be trillions of dollars worth company. And obviously, John, as an asset manager CEO, representing a global investor, is very pleased to hear the news. And that was June, July time,
Yeah.
and September, voila, policy bazooka. So do we believe it? The answer is yes. And look what they have said. Look what they have done. Market need to understand and differentiate. Don't just sell and ask question later. This is the time you need to ask question first because it does matter to you strategically long term.
Yeah. Yeah, I couldn't agree more. I mean, that, actually looks like, from friend Jamil and Todd and Steve, and we're getting a lot of questions on the ADRD listing, that this was something, and again, I talked about, everything, we really got involved on this issue around Holding Foreign Companies Accountable Act. Um, and I think it was important, so important to show that the Chinese government did actually change their law to allow this audit review, and the SEC has said that these companies do adhere. It's something that's come up a little bit in February. Now, this idea that these Chinese companies, because they use the VIE structure, were somehow non-compliant. I mean, that's the VIE structure was created by U.S. private equity firms that weren't allowed due to Chinese law to invest in Chinese technology companies that were private. So the VIE structure was created to allow this private equity investment that later on become public equity. So we think that some of the sound bites on the VIE structure are really not based on any sort of factual knowledge of why that structure was utilized. The Chinese government has recognized the VIE structure. There are private equity, foreign private equity firms that have brought companies public in China, listed in China using the VIE structure. So again, it's about foreign ownership, and that at the time was our number one. We started going to Washington, D.C.
Yeah.
We started meeting with members of Congress and saying the Chinese government does not hold U.S. ADRs. U.S. investors do. And if you threaten the risk, you're only hurting the investment of U.S. investors. And it's so disconcerting to see this issue that is just marred by factual inaccuracies being brought up again. And we do believe that for the Chinese government, it's an issue that is sensitive to them. And what's
Mm,
ironic is it shouldn't be, because if you make TikTok a zero, you're going to hurt the US pensions, foundations, endowments, and charities and pension plans that are invested in the US private equity firms that own ByteDance. And if you threaten ADR delisting, you are only hurting US investors. And it's just nonsensical to me that would be considered a potential I think it is a red line. It's a line in the sand, and just intuitively, you shouldn't, you should be encouraging, companies to the U.S. capital markets. This is capital controls, and I think I think at the time, on behalf as a fiduciary, on behalf of our investors, we went and met with members of Congress. We went and had to buy a few of them lunch. It was, but we'll be more than willing to do that again. This issue, the fact that that they could bring this up, you're not hurting China, you're hurting U.S. investors, and we will go back to Washington, D.C. To try to educate members of Congress on this issue. Yeah, it's very disconcerting. At the same time, we will continue to lobby companies like Pinduoduo to relist in Hong Kong for their, if you think about it, their ESOP plan, their option plans, the ownership of their employees is in that US ADR. Um, and that is exactly why companies like Alibaba and JD and Baidu have relisted in Hong Kong, just as a defense mechanism. So we'll continue to monitor this situation. We'll write about it when it comes up in ChinaLastNight.com. Um, and when and if this actually becomes an issue, we will go back to Washington, D.C. We have that legal obligation on behalf of our shareholders. We take that fiduciary responsibility very seriously. And we wish, it's one thing I will bring up, Xiaolin, is, you know, our peers aren't doing what we're doing on behalf of their shareholders. And I wish, there's other China ETFs out there, and people on this call probably own them, and they're rewarding people not doing their fiduciary obligation, something that we've done. And it really disappoints me to talk to investors and find out they hold our competitors. It's, you know, you know, yeah, it's it's what keeps the lights on. It allows us to do this. And yeah, please don't hold our competitor ETFs. They're not helping you. They're not, they're not going to at bat. They're not putting themselves out there like we do. Yeah, I, anyway. So yeah, to Steve, Rich, Jameel, Todd, definitely you know, we're, we're all over this issue. It's nonsensical. Um, but yeah, it's something that we will act, when necessary for sure. So hopefully we put that one to bed.
We hold everyone longer enough, 15 minutes overrun. Do you want to address another question, or we should please continue to send your question in, and if Brendan and I couldn't address all of them, which all great questions, I have to say, we will either you get in touch with us, we'll be happy to do a one-to-one, or we just answer your question that way.
Yeah, I mean, I think our friend Matt has been a big supporter and investor with us, so I feel we should we love everybody, but investors who but yeah Matt points out just maybe on what happened from what we've read, it was not China selling U.S. Treasuries. It was Japanese investors unwinding this basis trade in U.S. Treasuries, where you're kind of short the short end of the curve and long the long end, and that trade went backwards. We don't believe it was the Chinese institutions selling U.S. Treasuries. Um, Yeah, and then he's asked just around U.S. technology. I mean, it's interesting. That's one area where the Trump administration kind of backed off. They actually, it feels like they've not been quite as strict on some of the export controls around technology thus far. But yeah, in general, if please, if you need the presentation, please email us at info@kraneshares.com, and please email us questions. If you email us, we will respond. Um, but yeah, I mean, certainly, and yeah, definitely appreciate all the great questions. Please email us, and we'll definitely respond and as timely as we can. Yeah, well, thank you so much, and yeah, thanks again, Xiaolin.
Thank you, everyone.